Hello, my name is Simone Thompson, and this is my stock and bond comparison presentation. So, first, let's talk about the difference between stocks and bonds. So, the primary difference between stocks and bonds is that stocks represent ownership in a company, while bonds form a debt that a company or government owes to investors. Stocks offer the potential for higher returns, but they also come with a greater risk, while bonds generally offer lower returns, but they are considered less risky. So, you get to choose between the two different ones. I'm going to help you make that decision. So, why invest into stocks? In my personal opinion, these are three of the biggest reasons why you should invest into stocks. So, it helps build wealth over time, it helps beat inflation, and then there's also ownership and dividends. I personally invest into stocks, and I think that it is a great and very wise decision because stocks actually have historically offered one of the highest returns of any asset class. And over the long term, the stock market actually has averaged 7 to 10% annual returns, and that's after inflation. So, stocks is always, in my opinion, a really good way to go. Let's talk about the advantages and disadvantages of investing in stocks versus bonds when you're 20 and single. So, the higher potential returns that you get is a big advantage for investing into stocks when you're 20 and single. Stocks actually outperform bonds and they are perfect for young investors. And with time, when you ride it out through the ups and downs, you see a higher reward. You also will see compound growth, and this is when you start early, and this means that you have more time for your money to compound and grow. And then ownership of companies. So you're a part owner of a business that you really believe in, and your money's going to grow with the economy. Next, you have your disadvantages. So, with stocks, you really do see them swing pretty widely in value. And that can be kind of stressful. It's a little risky, especially if you need cash quickly. When you are in your 20s, I'm in my 20s, I understand that I need cash and I don't always want to invest, but I know that it's something I need to do. So, it might not be practical for a 20-year-old on a lower income. Also, it's an emotional investment risk. So there's fear during downturns where you might be tempted to sell and you might miss a future growth. I know plenty of people where that's happened to. They sell because they're nervous and they completely miss that future growth. Next, we're going to talk about the advantages and disadvantages of bonds. So with bonds, they are extremely stable. So it's a lower risk, the predictable income, which is great, something that you need when you are in your 20s. And then the bonds, they actually have fixed interest and it gives you consistent returns. And that's good for conservative investing. Next, let's talk about the lower returns. The disadvantages, which can be lower returns. So, bonds usually yield less than stocks, which means that the slower wealth grows, especially when you're young, it can take a little bit more risk. There's also an inflation risk. Bond returns might not keep up with inflation, and this could erode your purchasing power over time. And it's the same with interest rates. The longer that it goes, your interest rates are going to increase as well. All right, so next let's talk about the recommended type of stocks for someone in this life stage. So I would recommend an S&P 500, and I would recommend that because there are low fees, consistent consistent long-term returns. Also, there's dividend growth stocks where it's steady income and it's also capital appreciation. This is great for building passive income early. For someone like me, I actually reinvest my dividends so that way I can see a bigger return. And then we've got growth stocks, and companies expect this to grow faster than the market, which is why it's amazing. Um, for bonds, we have a total bond market fund. So this offers broad exposure with low fees and low vitality, validity, excuse me, which is why that type of bond would be great. Also, we have I bonds. I would recommend that because it's government backed, tax deferred, and it's inflation beating. So it's really going to help you, especially in the long run. This is something that's really recommended for someone in their 20s and single, no kids. I bonds, if you're going to go that route, that would be great. Next, you have short-term bond funds, and this is a smaller risk interest rate, and it also is low risk. And this is something that someone in their 20s needs. They need the money, and then they also are going to need that low risk. So I think those are great reasons and different investments that would be great. Now let's talk about 30 and married. So the advantages of 30 and married, you still have a long-term growth potential. And you still have decades until retirement. So growth from these stocks can compound powerfully, okay? And you're likely also earning more. So you're earning higher wages now, which means that you have a more stable income and you can invest more consistently, which I think that's great. That's going to give you a bigger reward. Also, you can invest more strategically because you're more experienced and you might pick better ETFs, sectors, or dividend payers. That's an advantage. And then we've got our disadvantages. So it's more of a financial obligation now that you're 30 and married. You guys are probably sharing bills, sharing responsibilities. So it could be a bigger financial obligation, the stocks. Also, you have less time flexibility because you're just being married. And then you can have a little paranoia about the stock market, but we're believers, so no paranoia in Jesus' name. Next, we have the advantages and disadvantages of bonds. So you get more stability for your family, preservation of capital, and regular income. At this stage in your life, that's what you've got. And these are going to be the advantages because you invest into bonds. Also, for bonds, a disadvantage is going to be that there are lower long-term growth. So because you're a little bit older, um, you could be over focusing on bonds and it could severely limit your wealth growth over time. Also, inflation is still there. You get about 3 to 4%, and it's not growing as much. And then also interest rate sensitivity. So if the interest rates rise, the value of your bond will drop as well. All right. These are the recommended top stocks for this life phase. So you have the Broad Market Index, which is a really good fund and it's an ETF. This is low cost, it's diversified, and it's a proven long term growth. Next, you have an international or an emerging market ETF. This one's different. It's diversification and it's beyond the US in case of a domestic slowdown, like we could possibly be seeing in our future. Hopefully not. And then also dividend growth stock or ETFs. This is steady income and it offers long-term growth. So this is great for future security, which is what you want to have when you are investing so early in your 30s. Um, so for bonds, you've got mutual funds. This offers stability. Treasury funds, which is safe and less interest rate sensitive, and then you have I bonds, and they earn interest on inflation, and it's backed by the U.S. government. So really, in your 30s, because you have so much time before retirement, everything is about safety, and that's why I would recommend all of these different bonds and stocks because they are so safe, and you really can't lose as long as you start. Next, we're going to talk about 40 with toddlers. So, the advantage of this, there's still long term growth potential and it's retirement and college. With having toddlers, this is the perfect time to start investing into stocks. By the time they're 18, they'll be ready to go for college. Once again, you're earning higher wages. The older you get, the more money you should be making, and you can invest this money more strategically. Also, there's disadvantages. So you have increased risk during a high expense, and this is a life phase, very high expense life phase. Normally we have your parents are retiring at this age. You're going to have more expenses because you're doing more. Also, you don't have that time flexibility, and then you could also have paranoia about the stock market. Next, let's talk about 40 with toddlers for bonds, the advantages and disadvantages. You're going to have stability. It's good for short, midterm goals, and then also goal based planning. So once you're in your 40s with toddlers, I would say bonds are a pretty good option. The only disadvantage is that you get lower returns, inflation, and interest rate sensitivity, but those basically are going to come with having bonds. Anyway, so let's talk about the different recommended stocks for this life stage. So I would recommend a 529 college savings plan. this is actually something that my mom started for me when I was a toddler. So I just love this. By the time I was able to by the time I went to college, I actually had money to go to college. It's low cost, it's diversified, and it's proven long term growth for kids. Next, you have the Schwab U.S. Dividend Equity ETF, and this provides a steady stream of income, and it tends to come from more stable, mature companies. Also, you have the Schwab U.S. Broad Market, and this is instant diversification across hundreds of thousands of companies and reduces risk from any single business failing. Um, for bonds, you have the Vanguard Total Bond Market. It's so interesting how these really mirror each other. This gives you broad exposure to the U.S. government and corporate bonds in one single investment. You have the Schwab Short Term U.S. Treasury ETF. This is less sensitive and it's rising interest rate. Next, you have the iShares TIP bond, and this is super safe. Inflation is adjusted, and then also these are bonds that grow tax deferred until you cash them out. So these are great for someone with toddlers, someone planning, great different bonds. Okay, now let's talk about the advantages and disadvantages. 50 with kids. So there's still a little bit of growth potential, which is great. Your dividends can generate income. And then also, it's still important that you're beating inflation, even at the age of 50. So these stocks will really help you beat that inflation. Now, the older you get, there are more disadvantages for stocks. So there's a higher risk of not turning a profit, and you don't have that much time to recover from downturns. There's also heavy stock investing carriers with high volatility. So that means that you have a bigger risk, definitely a bigger risk there. The advantages of bonds are higher. So you have a reliable income stream now. It's capital preservation, and there are lower returns over long periods. And over 50, it's not too late. You still have a chance for growth. The disadvantages is that there's a fluctuation in your return. There's an interest rate risk, and then also inflation could take away the profit of the bond because you're investing so late. The different stocks that would be beneficial for this, we have the Vanguard Dividend Appreciation, the 500 Index Fund, Invesco ETF, and these are all great because these are, different companies that offer, excuse me, short-term results because you're a little bit later in life. You need faster returns. Next, we have the bonds. You have the Vanguard short term bond, Schwab short term, and the Schwab US tips. These are great because they help protect your savings. It helps to beat interest rates, and then also um, they change a little bit less. The interest rates change less, and this would be great for something like tuition. All right, next we have 60 with no kids. So, this is an exciting life stage. So, you still could see a little bit of growth potential. You've got about 25 to 30 years left at least. This is going to offer you extra retirement money. This is going to extend your portfolio and longevity even at age 60. And then the disadvantage is there's a big market drop. You could lock in losses because you're withdrawing money when values are down. And then also you're taking money out of taking out when bonds provide stability. So there are bigger disadvantages the later you decide to invest into stocks. So there are advantages and disadvantages of bonds. The advantages, in my opinion, weigh out. So it says taking out of money provides stability with bonds. You get a predictable income. And then with 60 with no kids and you retire, you have more security with your money. You're not having to, you know, have an unexpected bill for a child because they're out the house, hopefully. Next, you have the disadvantages. So it could be too much reliance on the bonds, and it could leave retirees vulnerable to inflation risk. You could have lower return than your stocks, And then also there's a risk of being downgraded by rating agencies, which could have implications on the price. So once again, we've got different stocks and bonds that are recommended: the Schwab US Dividend Equity, Invesco, S&P, and then the iShares. So the S&P is great because it's the top 500 companies um, in the country that are doing great. And it's important if you're drawing income soon because the Invesco doesn't actually swing that rapidly. For bonds, you have the iShares Core US, Vanguard Short Term, and then the iShares iBox. All of these bonds are really good investments. Like I said, the older you get, the better bonds are because it's short term. And these actually protect against rising interest rates and they hold value, which is best for near term needs because you're going to have more near term needs the older that you are in this 60s life stage. All right. Lastly, we have 70s and retired. So 70s and retired, this is going to, when you do stocks, it's going to beat inflation over time. You have potential for higher returns, and then you have a dividend income. You can you don't have to reinvest your dividends at this point. You can just be your steady income, especially because you're retired and you're going to need that extra income. The disadvantages of doing this: there's a huge market risk. It could be extremely stressful, especially in the later stages of life. And then your losses are early in retirement can permanently damage how long your portfolio lasts. So it's not the wisest thing to do um, is stocks at this stage in life. Next, you have the advantages of bonds. This is predictable income again. It helps match your financial needs, and bonds move much more slowly than stocks, and there's less swings. So that's so much better, such an advantage, especially when you're 70 and retired. You don't really want to look at the stock market every day. You just have your bonds, and you know they're working for you. The disadvantages is that there's a reinvestment risk. There's higher hidden fees and costs. And then also, if you buy lower quality corporate bonds, the company could default, leading to different losses. Some of the recommended stocks and bonds for stocks for this age, because you want to kind of win big fast. We've got Johnson and Johnson, Procter and Gamble. Those are two established companies, and they have a high return. So the more you invest, the more you're going to get with those two. And they also are kind of a little bit recession proof. They tend to survive recessions better. And then you also have the iShares, and that helps protect against big market swings while staying invested. And that's for the stocks. Next and lastly, for the bonds, you have the iShares. This is the Schwab US TIPS. This is the Vanguard tax exempt bond. If you're especially if you're in a higher tax bracket, a municipal bond offers tax-free income, and that's what you're looking for. You're 70s and retired. You don't want to pay any taxes. There's your tax-free money right there. So, all in all, bonds are less sensitive to interest rate changes, and they are safer for money you'll need soon, whereas stocks are going to be a high risk but also high return. So it's up to you to decide what type of investment you would like to make. So I just want to say thank you, and I have included my reference sheet at the end. Thank you.